My name's Debra from the Property Frontline.
Hi, I'm Ken from Avvora Finance.
And I'm John Gilmovich from Real Property Manager. Welcome to Property Mythbusters, another session where we're busting some myths around property buying around Australia. And for the next 10 minutes, we'll be having a look at our September 2020 market update. And then Deborah will move on.
So, market update. So do you want to share your screen, John?
Absolutely. Okay, so hopefully everyone can see some data there, some rental figures.
Yeah.
Yep.
Okay, so how September is panning out in the rental market? Well, the rental market continues to be a challenge with continuing rental rate drops, mostly around our two major capital cities, Sydney and Melbourne, and in particular Melbourne itself as being the highest declines in rents, and that's obviously possibly due to the stage 4 lockdown they're in. So they're having further economic challenges there. But having a look around the differential between the houses and the units, it is generally the units coming off the boil where there is a lot of supply. Okay, so generally it's been Sydney and Melbourne having the most supply, and also Brizzy, so our east coast, where with the highest populations and the highest amount of stock, is causing the figures to go in the red. So these are the declines, the monthly drops around both the houses and units. But as you can see here, again, we spoke about this a few weeks ago. The houses are doing proportionally better than the apartment market, because the houses are generally not in oversupply. It is the scarce dwelling, and of course there's a lot of demand for homes with their quarter acre or whatever backyards, and still continue to be very, very popular with the families rather than them going into high-rise apartment living. So yeah, so they're holding up well.
And you can see there why Lewis Christopher is starting to, look at Perth more closely, because they do seem to be doing well, don't they?
Yeah, interestingly enough, I mean, things are ticking along, and this is the trend, Deborah, that's going on at the moment. Now, it's now a question of whether this is going to be a kind of a COVID permanent trend, or in fact, we're going through a change, and it's both a sea change and a tree change. Because if we look, we have a look at the vacancy rates. Look, the Sydney CBD, have a look at that. We were sitting around 16.2% vacancy back in May. It is easing off a bit, but it's still very high. It's just under 13% vacancy rate in Sydney CBD. Yeah. And Melbourne CBD currently in an upward trajectory with their vacancy rate in the city's CBD. People aren't there. I mean, you walk around Sydney City, it is a true ghost town at the moment. Businesses are shut, retail is down and struggling. I think Myer put out their figures last week and had a substantial drop in trade, something like $160 million loss from 12 months ago, where they were in positive territory. So the trend at the moment is, well, if I don't need to be in the CBD, then why should I be renting around those, high rental areas? The CBD itself, Piermont in particular is taking a nosedive. Surrey Hills, all those sort of fringes. There is this trend of moving out to the suburbs and, in some cases, moving regionally.
Yeah.
And look at the data here. You just have a look at the vacancy rate around the country. We start off with the East Coast. You can see, the vacancy rates. There's a little bit of ease here, but this is still demand. Supply exceeding demand with 3.5%, 3.4%. Brisbane a little bit better at 2.1. But if we dwell down, look at Perth, 1.1%, Adelaide just under 1%, Canberra, which is on record, Canberra at the moment, one of the highest yields around the country, has a very tight vacancy rate.
Delve into that.
Yeah, so you can see that there's big uptake of not only suburban properties, but alternative, if they can get there across the borders. People are starting to park themselves away from the high rent areas for the first time in years, because they don't need to be in the Sydney CBD office or their office or their CBD office full stop. So for the first time, renters are able to save. Renters are able to negotiate, better deals with their landlords and not be paying those high rents that they were used to for many years.
Yeah. Okay. Alrighty. Well, thanks for that, John. So, Ken, what's your perspective on the September 2020 market?
Yeah. Things seem to be holding steady. From what I know, the major lenders, or two of the major lenders, are still kind of struggling with the sheer volume of activity. So I think one of them was sitting at 30-something days, business days, which is about like a month and a half or 2 months. So
so you're saying people are having to wait that long to get approval?
Yeah. I think they're triaging the applications in that particular circumstance. So if, there's an actual purchase with a contract of sale, a 5-day cooling off period and settlement date, they will prioritize it. But in terms of refinances, it was like, at the time when I asked, it was like 2 months effectively, 30 business days.
Oh, wow. Okay.
And even with, pre-approvals as well, but it's kind of come down. It's gotten a little bit better. Hovering around about the 20 business day mark. But there is still a lot of activity, I guess, happening in the credit space. There were a couple of news articles stating that, there's been a lot of demand for credit, which is, I guess, a good sign, because from my perspective, there needs to be healthy demand for credit for that to kind of then flow on to the property market.
Yeah.
So what I'll share with you in terms of data that's come out, it's I just share my screen real quick. So you can see that?
Yep.
Okay, perfect. So it's better if okay. So this is just we're looking here at the mortgage activity from this year compared to last year. So this year is the blue line, the grays, the previous year. And although we're in this, pandemic, the demand for credit is essentially the same as what it was last year, this time last year. So that's something interesting to note, and it actually has been for quite some time. You can see over here when the pandemic actually there was like a strong demand for credit, and it literally just dropped off. And then it's kind of, stabilized since mid-June. So there is still a lot of demand for credit. Banks are still lending. Some of them are struggling with clearing all the applications, which is a good sign. There hasn't been much change in terms of the types of refinances compared to maybe 2 weeks ago. The refinance, is taking up almost 64%, or still 2/3. Purchases are still sitting at around 23, which is, I don't know, either 1 in 4 or 1 in 5. Well, I guess 1 in 4.5 applications, something along those lines. In construction is taking up. So those numbers seem to be relatively stable. And so it's quite healthy. And there's one thing that I'd probably note, if no one's kind of, actually taken a look at the interest rates. The official cash rate from the RBA hasn't changed in quite some time. There was a rate reduction a couple of months back, but for the moment, interest rates are sitting at around, for the fixed rates anyhow, 2.18 for owner occupied. At the start of the year, they were sitting around about the 3. People were kind of testing boundaries, whether they dip below 3 and things like that. But that's where things are at. So I was in a discussion. Actually, there was speaking to a financial planner who's in one of the networking groups that I go to attend. And he, mentioned that the RBA has basically decided to make the, I think it's like the government bonds capped at 0.25%. So basically, if you were to borrow money from the government, it'd be priced at 0.25, which is what's helping the lenders, I guess, offer that money, because they previously, or they do source money from overseas. But it depends on where it's cheaper to obtain the funds and things like that. So that is probably a big contributor to why interest rates have decreased and why they're low, although the official cash rate, which hasn't changed in a while. So that's everything from me in terms of what's happening in the credit space. How about your space, Deb?
Yeah, so from my perspective, let me share my screen. So activity, of course, from the buying side, we'll see a lot in the media about predictions about where prices are heading. And that is also tied to activity. So again, I'm showing here this graph that I've been tracking quite closely. Thank you, realestate.com.au. So what they're doing is tracking the amount of heat in searching, and as we've spoken about month on month for the last few months, the search activity really went through the roof. So you can see here, this is for residential searches. It was up around about 50% on their control level. Then it's had a little bit of a drop off, but now it's really starting to strengthen up. In relation to prices, we had some people coming out saying, oh, we're going to expect property prices generally to dive by 30%, 50%. And of course, even the banks were saying, oh, well, we expect like a dip of at least, around between 15 to 20%. But of course, this week, or actually last week, Commonwealth Bank and Westpac came out and revised their forecast, as they, are quite allowed to do. It is only a forecast. So did you hear that from them at all? Did either of you hear anything about that?
I don't get direct comms about the forecast, but I did come across an article stating that they revised it. Apparently there's going to be a slight dip for the end of the year, and then it's going to grow 2021.
Yeah. So basically what they're saying is that initially they were expecting an overall dip of around about 15%. Now they've revised that to Australia-wide to be around about 5% overall. So they're saying that we've already seen nationally prices dip by around about 2.5%. Westpac is forecasting maybe a little bit more of that in the next quarter, or like the quarter to September, and then start to recover. But look, basically they're saying that we'll be seeing a little bit of a flattening of the market, so a bit more consistency, but then a big rebound in 2022 to 23. But I guess what I would like to say in relation to this is really, it just goes to show how tracking sales prices really is not useful to forecast what's going to happen coming up. And of course, you have to look at individual purchases to be able to see whether you're going to actually do well or not. But in summary, it seems like everything's starting to settle down, and we're starting to see some, positive forecasting across the board. Do you have any comment on that, any of you guys? About what you're seeing or hearing?
Yeah, there doesn't seem to be, besides the media, out in public and on the street, the confidence seems to be there for those that are employed, have jobs. There kind of doesn't seem to be any fear, and it's looking like most of our major markets are pretty resilient at the moment.
Yeah.
The only effect really is on the investors' yields with the rental drops.
Yeah. Okay. Alrighty. Well, that's us for our market update for September 2020. Thanks very much for watching. If you would like to reach us, we can be contacted via our main websites. So Ken at avvora.com.au, John at realpropertymanager.com.au, or me at Property Frontline. Okay, so that's it. Thank you.
Right. Thank you. Bye.